want an exposure to a market or an
Everything they need in one place.
The world's foremost authority on individuals, advisors and institutions.
Hello and welcome to Morningstar. I'm Emma Wall, and here with me today is John Patello, co-manager of the Henderson Strategic Bond Fund. Hello, John.
Hi.
As part of our Financial Education Week, we're taking things back to basics for those who are coming to fixed income for the first time and those who need a bit of a refresher. So I wanted to ask you, what exactly is a bond?
Yeah, it's a good question because equities get a lot of press and bonds don't get much press at all. I mean, a bond is an IOU. It's a financial obligation. You lend money and there's an obligation to pay back that money. They're generally tradable. They tend to have a fixed maturity date and they have a fixed coupon or payment of interest which has to get paid. Otherwise, it's a default. So countries issue bonds and companies issue bonds as well, and they pay different coupons subject to the risk.
I think people are aware of quite how diversified equities are as a sector, and they tend to lump fixed income in together, whereas actually they're quite disparate and there are as many different bonds as there are issuers, in fact more.
Yeah, no, it's a really good point. I mean, fixed income is a generic phrase. I mean, Tesco's, for example, have over 50 bonds, but only one equity. In different countries, currencies, coupons, maturities, all sorts of things. There's lots of different types of fixed income. I mean, typically there's sovereign bonds, so countries. There's investment grade companies, so reasonably good quality companies. There's high yield companies, or junk bonds, as is known. There's asset-backed bonds, there's securitized bonds. There's a whole host, and the markets are absolutely huge. So there's lots of risks and returns available for clients subject to the objectives that they're trying to meet.
And a beginner's guide, it's good to use the rating system, but I think this can be quite confusing. You hear AAA this and BB that. Who issues these ratings and what exactly do they mean?
Yeah, there's two big rating agencies in the world. There's Moody's and Standard & Poor's. So the issuer of the bonds typically would pay them money to get a rating. Better rated bonds trade at lower yields than worse rated bonds. So there's an advantage of getting a rating. And as you say, the rating spectrum varies right up from AAA all the way down to CCC, and if not actually down to D for default. Half the universe is broadly investment grade and half is high yield, and it very much depends on. There's no saying that just because it's AAA it's a very good quality, but it means that you don't get much yield. And just in the same way, a junk bond or a high yield bond is not necessarily a bad thing. It's just a different risk return profile. And my job is really to get the best risk adjusted returns, as you can imagine, for the clients.
A very simplified measure would be, though, the greater the yield, the greater the risk?
That's exactly right. And you've got to build into that a degree of how long away the maturity is, the volatility of the bonds, and a whole host of different factors such as the cyclicality of earnings of the company you're talking about, the quality of the management team, the jurisdiction it's in, all those sorts of things would get blended up into the yield of the bond. And that's the rule of thumb which always works.
And I suppose it's your job then to balance chasing that income, which everybody wants at the moment, and going after something that's risky or too risky to invest in.
Exactly. And we are in a long credit cycle, which is getting reasonably mature. And I think buying, this month's issuance may not be the best return for our clients. If anything, we prefer some of the older, more reliable names who've been around for a while, bonds trade quite well, proven management teams, all that sort of stuff, rather than the late cycle types of bonds, in our opinion, where I don't think the risk-adjusted returns are necessarily that appealing.
John, thank you very much.
Thank you.
This is Emma Wall for Morningstar. Thank you for watching.